Okay, traders, welcome back. Here we have the NASDAQ Futures in front of us. So the futures market for the NQ or simply the NASDAQ, right? So here's a 15-minute chart that I'm going to be starting on. This is going to be a case study of how I'm looking at the NASDAQ or the NQ Futures, right? So with that being said, just going to quickly go over the first concept, which I often start with, is the idea of structure. So we're going to be looking at our structure first. Then afterwards, we're going to be looking at our most recent dealing range, and within that, we're going to be able to delineate our premium versus discount arrays. Okay, so these are the three M15 steps I'm going to be taking. The reason I'm starting on the M15 chart is simply because we have a bullish market overall, and there's no need to go to the higher time frames for this case study because it is simply a bullish market, right? So with that being said, let's dive into the charts, right? So the way that I'm currently looking at the structure is that we had a low over here, and this low over here produced a high, right? We saw a pullback over here and a lower high before we saw a break of structure to the upside again. Okay, then what we saw is we saw price retrace downwards, making a higher low before printing the all-time high and a new M15 high, right? So currently we are dealing in this particular structural range, right? We're currently dealing between this low down here and this high up here. Okay, so this is our structural dealing range from this low to this high, and it's at this point that we use the Fibonacci tool or the ICT PD array tool, as I like to call it, or simply the premium and discount tool, to project it from the swing low up to the swing high. Okay, so from the swing low up to the swing high. So from here we understand on the chart we have two areas we want to be studying and looking at in detail. Sorry, we have our premium up here and we have our discount. So what is the significance of this, right? Well, it's quite simple. We want to be looking for sells in the premium, right? So premium gives us selling opportunities, right? So we want to be looking for sells up here in the premium, and we want to be looking to buy up price when we're in the discount. This concept alone allows you to get out of a lot of trades that could potentially be losses and keep you out of ranging markets that are very, very choppy. That would then ultimately result you in break evens and losses. So how can you avoid break evens and losses? It's simply by using the premium and discount tool or the Fibonacci tool in the correct way to your advantage, from the structural low to the structural high, right? Just to give you an example of what I mean by that, you can avoid price action like this, for example, right? So if I zoom into price again, we have our EQ over here. So this is our 50% level or our EQ. Notice how price behaves at the EQ level, right? So we see a lot of choppy price action, right? Notably here, look at this range over here that I'm going to highlight in red, right? This is a very choppy range over here near the EQ. So it's best as a trader to simply avoid prices like this near the EQ. Okay, so with that being said, what I'm going to dissect in this trade is an NQ case study of a sell. So the first thing to understand is that this sell is in premium. So it's very important to understand we have a premium on the M15, right? Very, very important to understand we're structurally bullish, but we can still take sells from premium to discount because that's essentially how the IPTA works, right? So we have something called the interbank price delivery algorithm, IPDA, and IPTA works from premium down to discount, or if we were looking at a buy trade, we want to be trading from discount back up to premium. So this is essentially an overview of how IPTA works in the markets, okay? So that being said, let's dissect a potential case study trade from the 13th of March 2024, right? We're going to begin to dissect price action just over here, how you could have got in multiple positions, sorry, in this particular trade over here, right? Starting on the Wednesday, the 13th of March. So the first thing to understand is, right, we want to be trading away from liquidity sweeps and liquidity voids. Now, what do I mean by that? Well, the first thing I have to bring to your attention, right, is when we have pools of liquidity, right? So we have pools of liquidity, right? What do I mean by that? There's two pools of liquidity we want to be interested in, right, as traders. We want to be interested in looking at session liquidity and previous day liquidity, right? Previous day liquidity, right? These are the two concepts of liquidity that will appear on the charts more often than not, and we have both of them right here in front of us. So if I bring your attention to the left of the screen, what we had over here is we had the previous day high. So the Tuesday, the 12th of March, gave the previous day high over here, right? So this is our PDH over here, right? PDH. Now, it's quite obvious to understand that the PDH, or the previous day high, was swept in, well, on the next day, sorry, in that London session. So we see price coming up, sweeping the previous day high, giving us a Judah swing entry over here. So this here is the Judas swing entry. Now, what makes a Judas swing valid? Well, there's a couple of things that make a Judas swing valid, right? A Judas swing, typically, the Judas swing typically forms after a sweep of some liquidity, right? So we want to see liquidity that's being swept, and we want to see a displacement in structure. So we want to see a shift of market structure, a market structure shift, right? MSS. So these two things validate the Judas swing, right? So what makes a Judas swing higher probability is when we have a previous day high that's been swept, as well as, if I bring your attention to this over here, we have the Asian range high over here. That's also been swept as well. So we see the Asian range high being swept in conjunction with the previous day high, right? So Asian range high, so ARH or Asian range high over here is swept with the previous day high, right? Now from here, what we see is we see price giving us a very clear shift of market structure just over here, right? So what determines our shift of market structure, right? Well, it's quite simple. A market structure shift is determined when two candles pull back before giving a new high, just like this, right? So we see two candles pull back before the new high is delivered. This new high violates structure, making a new low, right? So we understand we're in a premium, so we should be looking for shorts anyway, okay? So now that we've had price deliver the Judas swing up here, and it's swept liquidity, so Asian range high and previous day high, what's the next thing we want to look for in the markets, right? So we want to enter off an order block, right? So what constitutes to an order block? What makes an order block valid, right? We want to be entering off an order block, right? So an OB or an order block for short has three rules, right? We want to see a shift of market structure, right? So our shift of market structure occurs over here, right? In that London session, right? So we see the Asian session accumulate liquidity, right? So this accumulates liquidity and we call it the accumulation, okay? After that, we see an OB or an order block, right? So this order block must break structure. So we have to see a shift of that market structure, MSS. After that, we want to see a fair value gap, right? And we understand our third rule is we want to see correct pricing. So we understand we're in an M15 premium, right? So we have all three rules ticked off here for an order block, right? Do we have our break of structure? Yes, we do. We see this arrow over here, which represents that shift of bullish to bearish structure, right? Our next thing we want to look for is a fair value gap. Now, do we have a fair value gap to enter off? The answer is yes. Fair value gap all across here in this region over here. So this fair value gap I mark out in blue represents inefficiencies in price. So we see a very clear fair value gap just over here that's being produced, right? So our job as traders is to identify a fair value gap that shifted structure with correct pricing after sweeping a liquidity pool. So it's a lot to take in, right? It looks simple on the chart, but there's a lot that actually goes into an ICT AMD model, right? So we understand we've seen liquidity sweep in the form of an Asian range high and a previous day high. We've seen price manipulate, giving us the high of the day, otherwise known as the Judas swing, right? And now we've seen an OB or an order block rule that's been established with three rules, right? So we see a shift of market structure, we see a fair value gap, and we see price in the M15 premium, right? So we want to be keying off a fair value gap, just like this over here, right? So I would have my entry just at the end of the fair value gap over here to ensure I'm tagged in the trade. A safe stop loss is going to be just above the Judas swing, and price melts off, right? Giving us a nice 1 to 2 or 1 to 3, I believe, or even more than that, right? So then the next question now becomes, where do we target? So because we are bullish, right? As a minimum, you want to be targeting what we call the EQ over here. So that 50% level just over here, right? So this trade again did run to the EQ over here, giving us a 1 to 6 or a 1 to 6.5. Lovely trade over there, using the basic concepts of accumulation, manipulation, and distribution. So just to go over that one more time, we start with the Asian range over here, right? So the Asian range high over here has been swept. This is the accumulation of the market. Here we see a build up of orders, right? We understand that it's a low volume time of day, especially on something like NASDAQ that moves in line with the USD, it's the US stock market. We're not going to see a lot of action. We're going to see flat action in the Asian session. The London session is where the volume kicks in and it gives us that Judas swing. And this is the manipulation phase. Now, our job is to catch the distribution stage. So the distribution stage is essentially all of this down here, right? So this entire move down becomes a distribution, right? So how do we catch a distribution? This is the question I often get with my students as well. How do you catch a distribution? A distribution is simply keying off a fair value gap, right? Keying off an order block or a fair value gap. So in order to catch the distribution, you want to be keying off a fair value gap in a specific time window. So this is a time window from 8 to 9 UK time, which is the London session essentially. So you want to be keying off a fair value gap in that London session, right? And that then allows you to catch the distribution stage of the market, giving you a nice 1 to 2, 1 to 3. I believe this trade ran to a nice 1 to 5 or 1 to 6, going down to the equilibrium level over here, right? So this is a basic overview of how you could have used the AMD on NASDAQ on this day, right? So if you like this video, give it a like and thumbs up, and I look forward to seeing all of you in the next one.